the Republicans maintain control of Congress, it will become easier to buy stolen goods by accident.
Okay, so Republicans maintaining control of Congress means that I could accidentally buy stolen goods.
That's right. You never know what's going to walk through the door. Welcome to the knock-on effect, where we start with the thing you know and end up in a strange place. I'm Alex Rosenberg, joined as always by my partner in crime, Justine Underhill.
Thank you.
And the real brains of the operation from an undisclosed location in merry old England, ladies and gentlemen, the professor himself, Roger Hurst.
As ever, happy to join you guys.
Justine, our job is to get you from votes to loot. Your job is to figure out where we're going before we get there.
Okay.
So, what do you think?
Okay, so Republicans maintaining control of Congress means that there are going to be maybe less regulations on eBay for some reason. I haven't figured out why. On China, something to do with Chinese goods.
If you were doing it, we would be going to China, but we're not. Roger, How would you grade that?
That was pretty terrible. For the first time, I'm going to mark Justine down. I'll give that, out of 10, I'll give that 3.5.
Yeah, I kind of just said random words. Well, that's what happened.
You're back to an Alex grade, so I'm happy about that. No. So let's start with what everyone knows, which is that a contentious midterm election is ahead in the United States, and control of both bodies of the cameral legislature, the House and the Senate, appear to be up in the offering. So, Roger, tell us about why people are watching this so closely.
There's a sort of seemed to be a good chance that the House might see the Democrats get a majority. I think about 60% chance at the moment that they think they'll get a majority in the House. For the Senate, it's still expected to be a Republican majority. So there is this kind of opportunity, and it's these first-year midterm elections, which regularly you see the incumbent lose seats throughout history. In fact, I think since 1862 and since the Civil War, in the House, 92% of these midterm elections have seen the incumbent lose some seats in the House. So it's always a little bit fraught for the president.
Yeah, no one's ever happy with what the government's doing, so you always see these back and forth switches.
Right, exactly. It's like it's as if you sat down in a diner and you just nothing's good at the diner, so you just
keep
constantly
ordering something
this
different.
dish is terrible.
Yeah.
And actually, we'll get back to that kind of switchy phenomenon in a bit. But so that's sort of the betting odds. Now, Professor, if you could walk us through some of the differences in policy, particularly, and we're going to financial regulations. So particularly around finance.
If you sort of take it to its very basic level, the Democrats believe that regulation is required to ensure that banks, pretty much everything, not just banks and finance, but everyone behaves better. And the Republicans think that a free market, or at least too much regulation, will be to the detriment of the economy. So you have too much regulation, it imposes too many costs, and those costs become more burdensome than actually the benefits of the regulation would actually have to the individual. So with all these things like Dodd-Frank and the sort of fiduciary rule and the Consumer Financial Protection Bureau, the Republicans say less. We want less of this, whereas the Democrats over the last few years have put layer upon layer of regulation to theoretically protect the consumer.
Yeah, that kind of also goes in a cycle as well. I mean, anytime there's a big financial crash, then we say, we need regulation. Right. And then when we're like a few decades
away, there's so much regulation.
Yeah, exactly.
Yeah. So those are kind of the overarching differences. But I want to hone in on something small. Small dollar loans in specific. So these you might be more familiar with other terms for these. So, Professor, when people talk about small dollar loans, what are they really talking about? By the way, I just want to thank the professor for being our U.S. election correspondent. I kind of enjoy that.
Okay, yeah.
But yeah, sorry, tell us a bit about small dollar loans here.
I think three or four types of the obvious ones. The most commonly used one is the payday loan, which is you have to have a job, a checking account, and the lender of the money gets first dibs on your salary when it's paid on payday. So these are usually short-dated, high levels of interest. There's car title loans. This is where basically you put your car title up to get some money. You hand over one set of your two keys, and if you fail to pay back the loan, the lender gets your car. There's the pawn loan, which is you take your stuff to a pawn shop. And there's also the one that everyone forgets. It's actually quite good, which is installment loans, which are repaid in equal monthly installments. But really, payday loans and car title loans, they have some pretty mean levels of interest on them.
Yeah, these loans can be pretty nasty. It's considered almost a poor tax in some ways.
Well, yeah, and I mean, some of these payday loans have annual interest rates of like 400% or something really insane like that. Do they literally take the other set of keys to your car? Is that real or is that metaphorical?
Yeah, no, that's true. What they're supposed to do is if you've got two sets of keys, one is handed over. That's your collateral, and wow. If you don't pay up, they come along and nick it. Well, take it.
Interesting. I didn't know that. So Republicans and Democrats, as with many financial regulations, have very different views about small dollar loans. And we've been talking about Congress. At the federal level, a lot of the policies do come from the executive branch. So specifically, a major set of federal regulations were issued by the Consumer Financial Protection Bureau. Now, the CFPB was created by Dodd-Frank. Dodd-Frank also gave them the ability to write a law about payday loans. And they were enacted by Richard Cordray, who was the director of that agency, is actually the only full director that agency has ever had. Because now Mick Mulvaney is the acting director.
Yeah, there have been some tensions around that.
Yes, in fact, Mick Mulvaney and the number 2 under Cordray both sent a mass email to the CFPB at the same day, both signed acting director. And she's actually suing to be acting director. Meanwhile, Kathleen Kraninger has been nominated to be the next director, cleared the banking committee, still has to go through the full Senate. So it's sort of a mess.
To be clear about that, the CFPB is something that Republicans are not a huge fan of.
Right, and that's just an interesting thing, because then who's going to nominate this agency that you think shouldn't exist? It's interesting. So, but they, in October of 2017, so into the Trump presidency, interesting, Cordray was still the director, they released a payday lending rule called the Payday Vehicle Title and Certain High-Cost Installment Loans regulations. Their rule, to quote them, is aimed at stopping payday debt traps by requiring lenders to determine upfront whether people can afford to repay their loans. Of course, it's always good to figure out if someone's going to repay before you lend them money. But more specifically, quote, lenders are required to determine whether the borrower can afford the loan payments and still meet the basic living expenses, and major financial obligations. More quantitatively, it limits the number of loans that can be granted to the same person, but it does not put a cap on interest rates.
Interesting. I was hoping that the title of that bill was an acronym.
I was looking for it,
no.
But no.
Oh, somebody didn't do their job. Okay.
Yeah. So normally I'd bring it out as a prop, but the rule itself is 1,690 pages.
Wow.
So
if you didn't pay back your loan, would you just file for bankruptcy? I mean, if it's 400% or something like that, and you took out a bunch of these loans, could you just, walk away from them?
It can lead to bankruptcies, yeah. For sure. And debt, in general, people who are concerned about payday loans always refer to this idea of debt traps. Okay. And this is why they're so concerned about taking out multiple loans in a row. Because you take out one loan for $100 with, let's say it's $30 interest, you pay it back in a month. Uh-oh, where am I going to get the $100? Take another loan. All of a sudden, you need $100. Now you're in the hole for 5Gs, right? So what's interesting about this rule is since it is so long and so complicated, the agency didn't require it to go into effect until August of 2019.
Oh.
Meanwhile, he stepped down from the commission. We have an acting commissioner, and Mick Mulvaney's come in, who doesn't like this rule, frankly doesn't like the CFPB, but the Republican-controlled Congress missed their May deadline for overriding the rule. Mick Mulvaney brought a lawsuit to try to at least delay the rule from going into effect and lost. He'll probably succeed if he does a better job of the lawsuit, actually. Those should be pretty regular. But it's just interesting because now he's forced to be manager of this rule that he doesn't think should exist.
This 1,000-page rule.
Yes, almost closer to 2,000. So the other thing that makes payday loans interesting is that it's very state-specific. So many states, less than half, but many outright ban payday loans, such as New York.
Oh.
And some have restrictions governing the cost of the loan, in other words, the interest rate. Others have restrictions about the number of rollovers, so how many times you can roll over the loan. That's
fascinating. That's especially fascinating because I would love to find out if, state by state, do payday loans actually help poor people because it helps them get a leg up, or is it a negative effect for them?
Well, I mean, this is a highly, I read a lot of papers on both sides. It's a highly, highly salient political issue.
Yeah.
So it's almost like saying, does abortion help people? It's like, well, it's a very moral thing.
It depends on where you stand, yeah.
And, since it is such a state structure, Congress has tried the Republican-controlled Congress has tried to impose some federal structure on the states. So recently introduced have been two bills, the Modernizing Credit Opportunities Act, or MSOA. Yeah, none of these have acronyms, unfortunately.
Darn.
And Protecting Consumers' Access to Credit Act. And both of those would basically restrict states' access to ban high interest rate loans by allowing banks to more easily partner with third-party institutions that could offer loans higher than the banks can. Yeah, so those bills have not been passed yet, and Mulvaney has not really succeeded in even delaying the rules. But it's clear there's something going on between Congress and the administration, that the winds around payday loans are definitely changing.
It's interesting to me because I wonder if banks, like the big banks, actually even want in on this space. I mean, it just seems like, as you were talking about, so fraught with controversy. If I'm a big bank, I would want to stay away from that.
So, wow, that's a very good transition to where we're going, because so it's actually, there are a bunch of different agencies and committees that govern small dollar lending. One is the Offices of the Comptroller of the Currency.
The OCC.
Okay.
You know me.
Yeah, great. Wow, naughty by nature reference.
Yeah.
So smaller banks had been making deposit advance loans, but they stopped doing so in 2014 after regulators warned banks not to provide products that could, quote, trap consumers in a cycle of high-cost debt that they are unable to repay. But now what's happened is that the Office of the Comptroller of the Currency has rescinded that guidance. They said, you know what, we don't believe that anymore. And the agency leader, Joseph Otting, had said, quote, it's not like that credit demand went away. It just got displaced into the most expensive segment. I personally believe that banks can provide that in a safer, sound, more economically efficient manner. And banks are already responding. So last month, U.S. Bank, which is part of U.S. Bank Corp., it's like the 5th largest consumer bank in the U.S., introduced the Simple Loan to, as they put it, quote, help consumers deal with unexpected or short-term cash needs with a transparent, easy-to-understand installment loan. And here's how it works. So if you have recurring direct deposits, basically if you have a job, then you can borrow between $100 and $1,000. You have to repay it over 3 payments in 3 months, and you're charged $15 for every $100 if you pay manually, and $12 for every $100 if you just pay it out of autopay. You cannot roll over the loan. Actually, you have to wait 30 days to take out a new one. What I really like about this is when they're telling consumers about it on their website, they say, Simple Loan is a high-cost loan, and other options may be available. So they're being very transparent. This is for short-term cash needs.
It's nice that they're being transparent. It also does not sound simple the way you described it.
Well, it's you give them $15,
Okay.
It's kind of, well, the 3 payments thing makes it a little confusing.
Yeah, right.
And yeah, so they're the first bank to offer a product like this, and as a lot of people point out, I mean, they're just responding to the signals they're getting from the administration.
And so this is something that U.S. Bank is looking into doing, or they are doing.
They are doing it.
So then, in some cases, do you think
other banks are probably looking into it?
Because a lot of the like payday lenders are smaller lenders. I mean, do you think that they're feeling threatened by some of this?
I think so. I mean, they're smaller and they charge much higher interest rates.
Yeah.
And it's like a little scarier to deal with a payday lender than with your bank.
Yeah. Although
I think it has different impacts on your credit depending on the state too. What's interesting, so there was some people saying this is great, some people saying, this is such, and it's a very high interest rate loan when you think about it. I mean, $15 over 3 months. I mean, it's expensive.
It's usury.
So that's what some people say. And if you look online for financial advice, you'll say, oh, don't take out a payday loan. Instead, save money, which is and Professor, you have some stats that speak to it. It's something that people have, especially in the United States, seem to have a pretty hard time doing.
The average kind of is quite flattering, but the reality is when you look at the median American household, there's absolutely nothing there. I think the median household is around about $4,800. Go Banking Rate survey in 2017 suggested that 57% of US citizens have less than $1,000. You can't do anything with that. There's hardly, get from paycheck to paycheck and stuff. So there's very, very low levels, and it's very, very much the millennials with the least, baby boomers with the most, but none of these numbers are particularly big at the median level for the US.
Yeah, I remember seeing stats that at least a third of Americans didn't even have 6 months of savings. So if they lost their job right now, they wouldn't be able to live for 6 months.
Forget losing your job. Let's say that you bust a taillight and you don't have $500 in the bank. You can't get to work. All of a sudden, you're going to lose your job, and then you want to talk about a cycle of debt. That's really, really dangerous.
Yeah.
So this this is where it gets interesting, right? These are the arguments, and sometimes it's almost like a proxy for wealth inequality. And I think a criticism of the regulations the Democrats are into is that, listen, a lot of people just don't have much in our society, and to say, it's almost like saying, oh, I want to eat chicken, I don't want to see the chicken get killed, you know? So, and this is the argument libertarians make. So the Mercatus Center, which is a bit libertarian think tank, they argued in a recent paper about payday loans, quote, those who use payday loans have limited alternative sources of credit, and these include pawn shops, bank overdraft protection, credit card. Bank overdraft protection is interesting, right? It is a loan when you think about it.
Yeah. It also just doesn't seem fair in some ways. Because it's like this is when I was a teenager, I accidentally went over the limit and took out all my money. But then it kept letting me take out more money.
Right.
And I didn't even know I was below zero.
Oh, I used to do that. I told my bank when I was in college, I told my bank to don't let me do that.
Yeah, but I had to do that. But I couldn't believe that they let me do that in the first place. I mean, I was a 16-year-old.
Well, it's a very high cost loan, right? Because it's $100 and usually $35, if you take out $100, $35 fee. So, so limited available source of credit, pawn shops, bank overdraft, credit card advances, and informal lenders. Payday loans are less expensive than these alternatives, which is sometimes true and sometimes not. There's also informal lending, by the way, like very informal lending, like, hey, Justine, can I borrow $100?
Right.
And that has very low interest rates, often no interest rates, but that's a little weird. So where we're going now is to pawn shops. And to refresh you on how pawn shops work, I don't know how much time you spend in pawn shops on the weekends, but
not much.
Not much.
I do live near one, though.
All right, very good. Is that basically to pawn something? I thought it meant to sell it. Really, it means you come in, you say, I have this very valuable diamond from a couple episodes ago, and it's worth about $200. So maybe they'll give you $100, and then you'll have to pay them often a very high interest rate. It's often like 200% APR. So you'll need to pay them maybe probably $130 in 30 days time. If you pay them, they give you back the diamond. Otherwise, the diamond is up for sale.
I will say I am somewhat familiar with the system because of Pawn Stars. So I love watching those TV shows.
Right. So that was my reference in the beginning. If you caught that, was you never know who's going to walk in the door.
Oh, very nice.
Yes. So that's one way that it happens. The other thing that is you can just come in and sell it outright to the pawn shop without getting a loan, or you can sell things that aren't yours, which is something that happens a lot as well. And now, if you talk to the pawn shop press, they'll tell you...
the big press corps of pawn shops.
They'll tell you that somewhere between 0.5% and 0.1% of goods in pawn shops are stolen. That's probably low.
Right.
And there was actually a really funny paper called The Effect of Stolen Goods Markets on Crime, Pawn Shops, Property Thefts, and the Gold Rush of the 2000s, referring to when gold prices were rising, by someone named Rocco d'Este, which is kind of a great...
That is a great name.
Yeah. Quote, after 2001 and 2005, we noticed an extremely interesting pattern, a rise in gold prices and a visible increase in burglaries that is only concentrated in counties above the pawn shop's median. The analysis suggests that burglars respond more to changes in the value of criminal opportunities in areas with a larger market for the trade of stolen property.
Huh. Say that again.
So basically, when gold prices go up, crime goes up only the crimes that are near a pawn shop.
Interesting.
So it basically means that more pawn shops, the more opportunities for criminals to sell things. And so the more responsive they are to market forces.
But why specifically gold?
Gold is often melted down by the pawn shops and,
okay.
just sold off.
Oh, okay. So so it'd be specifically pawning things like gold rings or gold jewelry or something like that. Okay.
Exactly. Okay. Which is really the stock and trade of pawn shops.
Oh, okay.
So basically, I guess the point I'm making is the stuff you see in pawn shops is a mix of things that people intended to get back but didn't have the money to buy back. Things that people just sold outright. And I still remember there's one episode of Pawn Stars where this guy was like an Olympic torch holder and he was like selling the torch. So sad.
I remember there's one episode where someone was selling a prosthetic leg.
Theirs?
No.
Wow.
Yeah.
Think they ran off with it?
Well, yeah. I mean, why would you? Oh, it was a historic one. That's what it was. Okay. It was like from the Civil War.
Good. Glad about that. So why were we talking about this? So it's a mix of things that people just sell outright and then things that are stolen. And so this is my thesis then. If the Republicans hold Congress, continue promoting small dollar loans, which are alternatives to pawn shop loans, it's more likely that fewer people who are hard up will have to resort to pawn shops. Therefore, a higher percentage of the goods in pawn shops will be stolen. Therefore, you're more likely to buy stolen goods by accident.
Oh, okay. So actually, I want to get to that link. So because but then why wouldn't people that just need the money who would be stealing stuff in the first place also go to the bank?
I don't think people are stealing gold rings because they need the money. There's probably some correlation there, but like if you bust a taillight, you're not going to go become a cat burglar and steal from the Louvre,
Okay, so there's a segment of the population that's already doing the theft, and so then the proportion in the pawn shops is going to be higher.
Like thieves don't just go and be like, oh, I can just take out a loan. That would be more convenient.
Okay,
it's a way of life, Justine.
Gotcha.
That's.
Now I will say, so this is a near-term thing. I mean, eventually everything's going to be on the blockchain. And so then...
Oh, my God.
Then, like, all these stolen goods, the pawn shop's going to have to go through. Like,
no, Grandma's not putting her old gold rings on the blockchain. It's never going to happen. Not now, not later. So as a note here, I just want to make a note, because it's not like the CFPB is unaware of this. It's not like they're unaware of the options instead of payday loans. Now, I just want to be clear. The U.S. bank loan is not a payday loan, but it has some similarities. So the word pawn shows up 104 times in the regulations we mentioned. Of course, it's thousands of words of regulations. And they also have some fun facts there. Did you know that pawn lending is referenced in the Old Testament? Apparently.
Oh.
Learned that from the thanks CFPB.
Oh.
But they exclude pawn lenders from the regulations for a very interesting reason. I'm going to read from the report. The consumer most likely does not rely on the pawned item for transportation to work or to pay basic living expenses or major financial obligations. In other words, if they can't pay back the loan, okay, it sucks. They lost their nice ring.
Gonna ruin their life.
Yeah.
Gotcha.
And it doesn't encircle them in this debt trap.
Right. Oh, that's interesting. I haven't thought about it that way.
And so since the Democrats aren't worried about pawn shops, it's like pawn shops actually are a beneficiary of the regulatory environment. So there's a company called Easy Corp, which runs Easy Pawn. Of course, unfortunately, it's an E and a Z. In 2007, it started a payday lending company with the unfortunate name Easy Money. And they left that business in 2015. They were then fined by the CFPB in the same year. And now, so they were a pawn shop company. Then they were a pawn shop and payday lending. Then they said, all right, forget payday lending. We're just doing pawn shops. So the pawn shop industry is actually benefiting from the crackdown. Professor, what do you think? Do you think you're convinced by the link between votes and loot here?
I thought it was a pretty good one, actually. I think the connection is very fair. But it just, again, shows how the system is set up that if you've got loads of cash, you can borrow cash for pretty much nothing. If you don't have any cash, you can't. And so everyone's just stuck in the loop, aren't they, in this kind of vicious spiral.
Yeah.
And that's the thing is, like, when we talk about interest rates rising from 2% to 3%, like, obviously it's important. I'm not saying that, like, those govern all these other prime rates and stuff. But for most people, it's like they're choosing between interest rates of like 200% and like 500%. It's a different world, and it's easy to forget. So you say, oh my God, interest rates are going up. People are going to have to pay more when they borrow. Well, they're already paying,
Yeah. And so in some ways, it seems like this fight over like all these regulations and stuff like that is kind of trivial in some ways, because it's like it doesn't really address the underlying issue that people are having to like put up their goods or whatever it is just to be able to get a little bit of money.
Well, and this is such a fascinating issue because we always talk about, there's the intersection of finance and morality is an interesting space. Even the laws about this are called usury laws, like you mentioned, which is like, it's such an old school biblical term.
Yeah.
It's just very interesting because the morality of access to money is like, the revolutionary thing would be like, well, anything is all a Band-Aid solution. Even if you make payday lenders lend for cheaper, it's such a Band-Aid solution because it just points to a fundamental fault in our society. Right. And then on the other hand, if you like the current kind of realm of where we are in terms of capitalism, well then, like, what's your answer in terms of when people are destitute? Are we just looking away from something we don't want to look at? Or are we really dealing with the underlying problem people have? It's a weird issue to think about.
Yeah, right. And whether, does regulation help reduce inequality or does it actually spur more inequality?
Right.
And so that's something that we have yet to fully address.
Professor, any final thoughts you can help us out here?
Well, I think this sort of the environment that we're in, this kind of world where it's expensive to, it's free to those who can afford it, very expensive to those who can't. It shows you that we're going to be locked in this cycle. So I don't know. I think that it's nice to see that they're getting the banks involved where the banks should be getting involved, and I think that's great. But the reality is, it's not going to change much for anyone, and those who can't afford things will still pay sky-high rates, and always will.
And guess what? I bet you it'll affect the lottery industry too. Maybe.
Yeah. That's a high cost. Well, it's the opposite of a loan. It's a high cost.
Still a poor tax in some ways.
Well, yeah, I guess so. Although, actually, a lot of the people who take out payday loans are more likely to be middle class.
Oh, interesting.
Because I think that maybe you buy more things than you can't afford. I don't know. A good explanation.
You have a certain standard of living that you need to maintain.
Yeah, I guess so.
Yeah.
Wow. All right. So a little dark this week, but hopefully we learned something. So thank you for joining us. We have a new episode every Thursday on realvision.com. And you can also listen to the podcast at Real Vision Presents. We'll dig into a little more. And we have actually a special podcast extra episode this week that I'm pretty excited about.
Yeah,
as well.
I definitely want to check that one out.
Yeah.
And if you go to the website, go to www.realvision.com/knock-on-effect, you can sign up for your 14-day free trial.
Yeah, we have a lot of good stuff on the site these days. We're in big name season, as it were. And, if you're watching this on Thursday, tomorrow we have a really exciting interview coming up and a whole bunch after that. So, good time to grab your free trial and check it out.
Yeah. Okay, see you guys next week.